Welcome back. In this video, I wanted to cover a super investor by the name of Robert Vinall, who is doing really well in 2025. In fact, he's the number one super investor that I've ranked. Year to date, he's doing great. He's doing 26.15% appreciation on the stocks he owns. I wanted to go through and just evaluate this super investor, tell you more about him, what his historic returns have been, and the effort is really to learn something for me, to learn about his style, see what he how he likes to invest and where he's been successful, potentially where he's failed. This investor is humble. I really like that about him. He doesn't claim to be the best or the greatest and so forth. He's actually quite humble, but his returns in the last 3 years are really, really good. So I think there's something to learn from Robert Vinall. I'll take a look at his portfolio and I'm going to drill into his top three winners. I'll also drill into some of his losers and see what's gone wrong with those stocks. But out of the top three stocks in his portfolio, I'm already eyeing one of the companies that I didn't even know existed. And I'm really going to be interested to watch that one company. I'll tell you about it in a few minutes. So let's get into Robert Vinall. We'll take a look at his portfolio, drill into it, and see what we can learn from this investor. His portfolio, his biggest position is Carvana, second biggest Meta, and then Prosus, which is a company out of the Netherlands that does e-commerce, Credit Acceptance Corp, and then Wix. In the countries he invests in, most of his stocks are located in the U.S. Second country is Netherlands, Cayman Islands, Israel, and then Norway. 3 years, Vinal's done great. This year, he's doing about 26% year to date. Last year, he did 57.9. Nicely done, sir. And in 2023, another great year, 44.4. So Vinall really picked the right stocks 3 years in a row. Back in 2022, along with everybody else, the S&P was down 26, 28%. The NASDAQ was down 36%. And Vinall's portfolio was down drastically because he picks stocks that are growth stocks. He really believes in them. So the last 3 year return has been excellent. He does charge a management fee of 1.1%. And if I was a holder of his fund, there would be no complaints from me. You perform at these levels, you can have that 1.1 and a big thank you. Now let's take a look at his portfolio and see what he owns. And then I'm going to drill into his top three and then his biggest loser. So the biggest stock is Carvana, and I have to tip my hat to this investor. Carvana was almost bankrupt. This was a high risk, high reward situation, and it really was rewarding for his investors. In the first quarter, this stock went up 65% for him. He made $73 million for his investors. Nicely done, sir. And in the second quarter, it went up a little bit more, 10%. And since then, it's also appreciated some. So Carvana was a genius move. And I have to say, it took guts because, again, that company was in a really bad situation where it had a lot of debt. Cars had lost a lot of value. Their cash flow was terrible, but they were able to pick themselves up. And the stock was so low that he picked it up at a really good price. Nicely done, sir. Carvana year to date is up 82.89%. The 1 year up 141%. And here's the 5 year. This is what I was talking about. When you had car prices, used car prices really collapse, this company was caught in no man's land. The stock price got as low as, $8, $6 a share, $6.94 a share. And now it's trading at $371 per share. Incredible. So those investors that took the chance here, they deserve that appreciation because, again, when I looked at the stock, I was like, this has a pretty good chance of being bankrupt. And they didn't. Good for them. Good for their employees. Good for the investors. Now, Carvana is an $81 billion market cap company. Revenue 16.27. P ratio is looking pretty expensive, 92 for the current year, almost 80 for the next year. And analysts think it's fairly priced and it's a buy. Looking at their growth, it's really good growth. Now, is this growth going to continue? That's tough to say, but I would comment that car sales have not been all that great on the new side. And on the used side, I don't know that they're going to be all that great either. Reason being is I think cars are lasting longer, and I don't think the economy's booming. Now, used car prices should do well in a in a bad economy or in a good economy. So it's a little bit kind of wait and see how revenue ends up going for Carvana. It is not a very profitable business. When we look at Carvana, the cash flow is pretty bad, frankly. For that kind of revenue, they're just barely getting $615 million of free cash flow. And in the past, they just burned cash, especially in those years when things were tight. Margins 21.89. Now, this is the used car market. So it's not a big deal if they're doing volume, right? But it's not stupendous. And they have grown their margins more recently. You see that their margins, when those used car prices were really bad, their margins became really, really tight. They do pull off a good profit margin, but only 3%. So overall, this is just what it is. It's a used car e-commerce company. They're growing very fast. But for me, I love growth, but I love profit as well. And I love free cash flow. I'm always aiming to find the perfect company that has all three and has a really good balance sheet. This company, its balance sheet's gotten a lot better, but it's not out of the woods yet. It has a debt to EBITDA that is above three, just slightly above three, not too bad, but it is a little bit of a concern to have debt to EBITDA at 3.33. It should be below three. And if they can continue to pay off debt, that'd be a great idea. I completed a valuation on Carvana, and I'm seeing that the stock is priced really high. I actually think the stock price is priced 66% above intrinsic value. If you look at the free cash flows, they're not very good. So if I value the company based on cash flows and give them a good growth rate of 20% and a very good long-term growth rate of 5%, I'll only come up with close to 25 billion in intrinsic value. When I compare that to the market cap, we're a far distance from market cap. So this stock is 74% too high when I compare the intrinsic value of the company based on its cash flows. Earnings per share is a better situation, but it's still not perfect. I can't give these guys more than 24 PE. They're not strategically positioned like an Amazon. They're growing, which is good. I'll give them a 24, and that's all I'm willing to do because their margins are so tight, and they don't produce a lot of cash flow. I'll give them a good growth rate, but when I value them based on their earnings per share, I think the stock is priced 50% too high. Now, it's not out of the question to think that this stock's overpriced because the market's taken this stock to such a high that I think it just exceeded where it was supposed to get to. Remember, this stock was trading less than $7 per share 2 years ago. And my valuation's like, I believe their stock's worth $126, well above $7, but well below $371, which is their current stock price. For me, this would be a complete pass. I wouldn't buy Carvana, but Rob Vinall made a lot of money on it. Good for him. Vinall also owns Meta, which has done really well for him. Year to date, it's up 26%. He owns another e-commerce company by the name of Prosus, which is in the Netherlands. And he's done really well with that stock. It's up 36.78%. Nicely done, sir. And he's made $31.9 billion in that stock. And this is in US dollars, although I'm going to show you a lot of figures that are in the euro. In fact, let me show you more about this company and their fundamentals. Prosus has a $117 billion euro market cap, revenues 5.7 billion euros. P ratio looks pretty sensible at 11. We just saw Carvana way up there. And forward P is 14. So this one looks pretty attractive, frankly. It's done really well year to date. The 1 year looks fantastic, 61.89. This is an e-commerce company, and they provide their e-commerce services in Asia, Europe, Latin America, North America, and internationally. So this is another one of those e-commerce platforms. I really like these kinds of businesses. They're growing well, 12.86% on a $6.1 billion revenue number. And this one is in US dollars, excuse me. That's really good growth. So The free cash flow for this company is far better, $1.837 billion. That's excellent. Nicely done. It's a lot better than Carvana. Gross margins of 42.5, and they've grown their margins. You see that over time. So they're probably getting their business really dialed in, focusing on products that do better for them. And overall, they have good free cash flow margin, good profit margins. I don't believe these figures here. They're not doing 200% profit margin. So that looks really good. And the balance sheet looks good. Balance sheet has more cash than debt. I'll put that into my valuation, which puts them at a very strong capital position. Very good. I'll take the earnings per share from the previous year, which expanded nicely, and use that in my valuation as well. Valuation for ProSeuss, when I look at free cash flows, and I kept everything in euros since their market cap that I'm working with is in euros, the stock price is 56% too high based on its cash flows that it produces. And I used a logical growth rate, 12%, which is their revenue growth. I am using a discount rate of 9%. And if we change it to 8%, that does improve the situation a little bit better. But since it's out of my home country, I'm going to go with a 9. I just can't keep an eye on them like I can keep an eye on a US based company. I use a 9% for Alibaba as an example. So it's outside my home country, it automatically gets a higher discount rate. Earnings per share is a good number, a PE of 25. So they're actually showing that if we value the company based on earnings per share, it's discounted by 66%. When I combine the two, the stock is discounted by 21%. This is definitely a good stock to watch. And if it were to come down, maybe offering a 35% discount, I would be all over this stock. Moving down the list, he also owns Wix, and this one has been a loser for him. He lost $24.7 billion for investors. That's quite a haircut. And this stock here has had a rough year, but might be a really good opportunity. Stock beginning in January of 2025 has just really gone down. It came down from over $225 a share down to 141. So it's been a rough ride for investors, including Rob Vinall. This is a small cap with $7.89 billion market cap. Revenues are 1.87. The PE ratio for the current year is a little high, but next year looks pretty reasonable at 21. Analysts think it's highly discounted. This company is growing, 13% growth on a pretty respectable number, $1.86 billion of revenue. They have good margins and cash flow. The cash flow has been growing nicely, and the gross margins are very good, 68. This is the highest gross margin stock that we've seen so far out of the three that I've shown. And overall, their free cash flow margin's good, profit margins are decent. So this one's looking pretty good. The fundamentals look pretty darn good. Balance sheet's good, and their earnings per share also is expected to be very good. When I look at Wix and value the stock, it's really discounted. The cash flows are really good. They're growing the revenues. So my goal is to find good growth stocks that give me everything. Good cash flows, good profits, good balance sheet. And Wix has all of the above. Good growth, good cash flows. In fact, when I take the net present value of cash flows and compare it to its stock price, it's 57% discounted. When I look at the profits and look at earnings per share and value the company based on earnings per share, 41% discount. And I'm using the same discount rate that I just showed, even though this is a company that's local to me. And overall, 53% discount. I really like this so much that I am a stockholder. So this is one stock that I also own. Rob Vinall owns it. Now, I just started buying into this stock because I saw that the big sell-off was an opportunity, and I bought into the stock. Now, it's good to know some super investors also believe in Wix, and just a little more confidence in owning these shares, and I'm going to probably buy more shares of Wix. Vinall has invested in China. He owns Pinduoduo. He also owns Yum China Holdings. So that looks good. Pinduoduo has done well for him, up 23.95. He's made $7.7 million for his investors. The next percentage one that really sticks out positively is Interactive Brokers. And let's take a look at that one. Interactive Brokers looks great. It's a $27.7 billion market cap company. The stock is pretty much doubled over the 12-month period. And this company is a brokerage, and with the stock market doing so well, they get to really grow their business and make lots of money. The revenue for the company is 5.6 billion. They have a P ratio this year of 32.7. Next year, it's dropping to 30. Analysts think it's a strong buy, but it is priced a little high. The revenue growth looks really good, 18% in the trailing 12 months, 17% in 2024. And it's been growing pretty much every year. Looks really good. They make plenty of money because what they're doing is they're providing a platform, and they have plenty of cash flow. Look at that tremendous cash flow out of this stock. Very good margins, and just really looks good. Brokerage stocks have done great. This one, along with others, have done fantastic. When I value Interactive Brokers, I come up with a 30% discount available on this stock. This is a good stock, attractive, really doing well. I own Robinhood, and I'm doing great with Robinhood. No need to expand too much further from there. I also own Futu in China, and that's doing great. And I started to buy into eToro to cover Europe. And this one here is doing really well, and it may likely go higher, especially if we stay in this bull market. To finish off the list, he also owns Yum China Holdings, which I believe is like Taco Bell, uh, KFC, those kinds of restaurants in China. And that's losing a little money. He had two stocks lose money in 2025. That's not bad at all. He also owns Google Alphabet. And this, I think the reason why his portfolio gained some spots on my listing is Google Alphabet's in rally mode. It's up 20.81% since he owned it, since he bought it, excuse me. And overall, that's been a good winner for him. He's made well over $1 million on it. So that's helped his performance. He also owns Microsoft, which has done really well this year. Paycom, it did well, and then Deere. So overall, he has a 26.15% rate of return on his portfolio, easily beating the S&P, which is at 11.83. I'm Rob Vinall, and I really like his style. He's down to earth, humble, but really smart. And as I showed, has made some really good investments. He has an investor meeting coming up this winter. I look forward to hearing more comments from him because what he's done this year is impressive. And he's also had an impressive 2024 and 2023. So, not the most celebrated investor that you'll see out there, but most definitely he is really getting it done. And based on how I'm tracking performance, he is the best performing investor in 2025. That's my coverage of Rob Vinall.